Thank you, Mr. Chairman. Mr. Secretary, thank you for your service, your testimony. You know, I was reading, as someone who wrote a letter to you on this issue, on LIBOR, that documents were released by the Fed bank show that as early as August 2007, Barclays told Fed analysts about possible problems. And you've testified earlier that sometime in earlier 2008, you made not only recommendations to the Bank of England, but you informed, correct me if I'm wrong, the Securities and Exchange Commission, the CFTC, and the Fed under Federal Reserve that had the control here. Those are all 2008. Now, let me just see my history. 2008. Who was the President of the United States?
Well, you know the answer to that question, Senator. President Bush was president.
Right. And who were the appointees in those respective agencies made by?
By the President of the United States and confirmed by the Senate.
Okay. So we start off with a reality that this was known to entities going back into the Bush administration. And when you became aware of it, you raised it to all of those appropriate entities that had the wherewithal to conduct investigatory abilities to pursue. Is that a fair statement?
That's absolutely a fair statement.
All right. So with that in mind, so that we cast this in the appropriate context, it still is challenging and troubling because obviously the reasons that Barclays enters into a consent agreement is they did something wrong. And when they did something wrong, there is a manipulation of some sort. Now, depending upon that moment that you borrowed, as has been said, you might have actually benefited, or you might have actually been caused harm. And considering how many mortgages and other commercial instruments are indexed to LIBOR, that's a real concern. My question is, how as we move forward here, how has the Treasury or the Fed considered issuing our own American LIBOR or using banks' data when calculating a number? Is that feasible? And how do we prevent this from happening again? Because one of my frustrations is that we can, in the Congress, pass and have the President sign laws that define what is acceptable and unacceptable practices. But we can't seem to get the culture in financial institutions, many, not all, but many financial institutions, to accept that. So one is, can we have an equivalent of an American LIBOR or other index that would be more transparent, less subject to any manipulation? Two, and how do we get the culture here to turn around?
Let me start with the latter question. You need tough rules, tough safeguards, enforced by people who have the resources to enforce them. There is no alternative to that. You can't regulate for ethics. You can't regulate for culture. You have to assume these institutions are going to have incentives to do the wrong thing sometimes, take risks they understand, don't understand. That's inherent in finance. The job of Washington and government is to make sure that there are tough rules in place that can be enforced, and that requires resources, not just authority. Now, we are looking very carefully at not just what reforms make sense to how LIBOR is determined, but what alternatives might be better for the system to LIBOR going forward. And we're going to do that very carefully and involve all the relevant people. And we'll brief this committee and the Congress as we go through that process. As you're pointing out, it's an interesting thing that an interest rate that affects the price at which Americans might borrow in dollars was set in London by a group of foreign banks, largely by a group of foreign banks who needed to be able to borrow dollars occasionally under a process overseen by the British Bankers Association. It's a strange thing. And so it is right to think about what's a better alternative to that now, and that's one of the things we're very focused on.
Well, I think the question is very ripe to think about what is an appropriate alternative here. And I appreciate your answer to my question of culture, but let me just say that if we have the rules, the regulations, the laws, and even if we give, which I support, the regulators the resources to pursue this, what we need is vigorous sanctions at the end of the day so that people get the message this is not simply the cost of doing business.
I agree. That's what enforcement means.
And I have a challenge here with many of my colleagues who actually want to retract from those vigorous sanctions and the essence of the process that would bring us to a determination when someone should be sanctioned, because otherwise we're not going to change the culture. And the American people are ultimately going to be subject to the risk of those who make decisions that ultimately create collective risk, and that's a huge problem. Finally, I'd like to ask you, can you tell us, at a time that your testimony talks about European debt crisis remaining a looming challenge for the United States, with the possibility of defaults in certain countries, what have we done to know the full exposure of U.S. banks and other institutions to the debt of European countries? And if they were to materialize at this point in time, what are we doing to limit the effects on Americans in that context?
Very good question. The Federal Reserve has, throughout the past 3 years, not just carefully looked at how best to measure the potential exposure, actual and potential exposure of U.S. banks and other financial institutions to those parts of Europe, but as I said in my opening testimony, we forced banks to hold much, much more capital against the risks than they held before the crisis, $400 billion more capital than they held before the crisis, and banks have moved very aggressively to significantly reduce and limit their exposure to the risks you pointed out. That's happened in money market funds too, by the way, which is important in this context. Now, it's important to recognize, though, that Europe is a very large part of the global economy, and the largest, strongest economies in Europe still are very big, very consequential. So a prolonged, serious financial crisis in Europe that goes well beyond a long recession would still have significant implications for our economy, because export growth would be weaker, financial conditions would be tighter here, and that would add to the pressures we're facing on the U.S. economy. But U.S. institutions have much less exposure. They hold much more capital against the risk in that exposure, and that's a good thing for us.